And joining me on the podcast right now, and of course, you can see us both live in video. I may be a little, well, I don't know. I've just come back from Tenerife port. I tell you what,
you look very brown. You certainly look very toned and brown.
Yeah, but you know what? It's nuts. It's a 4-hour flight away. I was looking at I always like to look at the weather app back home, and literally every day, 10 degrees raining, 10 degrees raining. And, out there, it was like 28 degrees sunny every day. So it was nice. In fact, a little too hot, but I do, you don't want to complain about that.
I would agree. It's absolutely terrible. It's even worse, actually, because my wife and my two daughters have all gone out to New Zealand for 2.5 weeks and are sort of like traveling down around the South Isles. And they've got beautiful landscapes and scenery. Yeah. Plus, it's just blue skies as well. And I'm sitting here in Birmingham. It's bucketing down. So you're right.
What's going on in the weather? Hopefully we're taking a turn, like I say, into Easter. Spring's upon us. I do find for a while the winter and the spring have been fighting, and the winter's been winning. And hopefully, as time goes on, it's like the market, stock market. In the end, the market goes up, but you can be forgiven for thinking it always goes down. If you've had a bear market for like 18 months, then it does feel like that. But longer term, it plays out. In fact, while I'm on holiday, I don't really keep up with the macro side of it. I did come back last night and I saw, like on CNBC, saying, heightened fears of recession are now playing out on some data, and I don't know what the data was. So what was that? What was the data that was coming out that people starting to worry again about recession?
Yeah, I think you just got to put it into a bit of context. Let's be clear about it. The markets have actually gone up in Q1. They roared in January and February, had a bit of a bump with the banking crisis, but still ended up. I mean, you had the S&P up sort of like 6% in the quarter, and it's still trading on around about 18 times price earnings. So it's not exactly cheap. So yes, we've had a bit of a sort of like a bit of a sell-off in the last few days, but I actually don't think it's a sort of like a major capitulation. Certainly not at the moment. The concern when we're talking about with sort of economic data is a lot of being sort of PMIs in manufacturing. We've had, I think it's 5 or 6 consecutive months of contraction in the manufacturing side. Services has also started to cool. But the good thing is that there's no doubt about it. Inflation is coming down. I don't think anybody can doubt that. We are going to get the non-farm payrolls on Friday from the US, and that should confirm that we're going to see some wage reduction. It's about sort of 4.5%. I mean, we're not really slamming down, but certainly sort of cooling off. So on that basis, if we've actually won the fight over inflation, then you've got to look at sort of like, what's the Fed going to do? And the Fed, to a certain extent, has intimated that it's going to hold rates for longer. It may push it by another sort of 1/4 basis point at its May the 3rd meeting, I think it is, and then hold them for the rest of the year. But the market has nothing like it. It just says, forget it, mates. We're going to see, you're going to be cutting aggressively. And they've already baked in a sort of 75 basis points or a percentage base points for the rest of the year. And then continuing down in 2024. The big sort of like, conundrum facing the markets at the moment is what are going to be the aftershocks of the banking crisis. And I had a really good video, and I think people should have a look at it. I spoke to Chris Watling of Longview Economics and Edmund Shing of BNP Paribas earlier the week, and they really were excellent in terms of the macro shape of it. And they pointed to the M2 money supply out in the States. And when you look at the charts from the St. Louis Fed Reserve, you just see it's basically it's like the Alpine ski slope. You just see this M2 money supply coming down and tightening credit from the banks, from the regionals. And I think also you look at sort of like early signals, sort of like leading indicators. And another one I'd point investors to have a look at to continue every single week is I think it's the Atlanta GDP now reading, which say comes out at least once a week, if not more. And it's actually rolled over quite hard in the last sort of like, 10, 15 days from a prediction of 3.5% GDP growth in Q1 to 1.7. So it's halved. Now, who knows whether that is a trend or not? But when you could just come in big picture to your concerns, the market is getting spooked by these leading indicators of PMIs. You've got your senior loan officers in the banks basically saying we're seeing tightening credit. You've got the M2 money supply, which is basically like, the Alpines. And you've got, the GDP now also coming down. Who knows where we're going to be? The next big data point is going to be the earnings season. I don't know what your thoughts are heading into, because that's going to start with the banks next Friday, I think. With usually starts with sort of, JP Morgan and Citibank. So I don't know what you think in terms of that whole earnings season, because that's going to, once you see the earnings, that will drive where the market is going to go.
Yeah, well, do you know what? It's just very interesting. Just looking at saying, talking about predictive indicators, and like I said, the inverted yield curve has been sort of predicting this for a while, and we've had sort of data points come out from the Fed about inflation rate coming down, the market sort of rallies, and you have sort of a hot point or something, and it goes back down. I just think how much this is baked in already. Like I said, the market has been down, going sideways for a while, and is it a case where it's pretty much almost priced in, and we'll just go in a range?
Not on the S&P it is, and not on 18
Yeah.
times it is, and not with basically. But obviously, it depends on where your cost of capital is and your borrowing cost. But we know, from the companies that we look at, if you'd have to sort of like raise debt finance, it's usually convertible and it's usually warrants on top. And it's at 10%, so it isn't exactly sort of start ravingly cheap, is it? And then let's just put ourselves into the position of a sort of like a small or micro cap or even mid cap company. If you go to the bank at the moment and it wants to basically increase its liquidity, is it going to roll over your debt? And the answer to that is question. It may do, but rather than being a damn certainty that it was before, it's sort of like it's going to start saying, okay, well, pay us back some of it, and I'll give you 50% of it, and then you've got to go cap and hand to somebody else. And it all depends on how much liquidity is going to be given and credit given by the banks. And I think where the market is getting a bit worried is that actually, if they all start to tighten, which is what the M2 money supply is saying, then it means that it's going to be really tough for companies to roll. It's like basically you get your mortgage, 80% loan to value or whatever it is. You come to renew it after 2 years and say to the bank, can I have another 80%? And they say, no, you can have 50%. What do you do then? So you have to find 30% of your equity somewhere in your house. Well, that's what companies have got to do. They're got to go and raise 30%, and that's convertible debt at the moment. So that is the issue.
Yeah, there's definitely, like I said, fallout, isn't it? And no one knows, how much this is going to affect. But do you know what? Even looking at average, like I said, the S&P, for example, you're right there. I mean, looking at average falls for recessions, this is going back to 1928. And if you looked at them, this would take the S&P to an average fall, of all, with recessions, with and without recession bear markets, it should be down to 3165. What are we at now? 4,090, pretty much, in the S&P. And so, but the average is recessions only. This is just bear markets with recession, or this is just recessions only. It's a 2782. And they last for 16 months on average. So we're not there,
Yeah. Have you got enough sort of data there, though? I mean, is 100 years enough there, Justin?
Well, 1928 for it, exactly. That's from, in fact, I've seen you sort of tweet out. It's a guy from Charlie Bellilio. Is it on Twitter? You know that guy? I think you looked at his inflation. He puts lots of detail on.
Oh, okay.
It's worth following him because he literally all he does is spreadsheets on data. And you can see trends in there, and it's phenomenal. So I'll just pinpoint this in the chart. We're way above, average falls on 100. That's the thing, isn't it? It's odd to see when you look back and you look at data. So how far back should you actually go? Because the markets have changed massively. Just liquidity, the speed of transactions. Everything has changed, and so
that's
it's
before.
Hard to know.
1928 was before the Second World War.
Yeah, well, this was a Great Depression, I know, but some people are saying
they just got out of the trenches.
Yeah, but if you look back, and oddly though, if you look back even at the inversion of the yield curve, it's worse than it ever was. If you go back to 1980, all I've got on that is 1980s, and right now it's worse than further back than that. So I think, well, maybe
if you look at the 3-month, 10-year US yield curve inversion, I think it's at about 1.5%. I mean, that's how negative it is. And the worst is actually the 2 and the 10 is now starting to steep, to effectively steep and to unwind some of that. And that's absolutely a categorical slam dunk that the recession or a slowdown is actually happening. Now, you can get
what's going to happen then, though, is the Fed will say they're going to stay higher for longer. They will say that, of course they will. But of course, their mandate is about employment and stable prices. So when one affects the other, and like I said, employment is a lot more political and it's a lot more emotive than inflation does. So what they're going to do, I mean, they're going to have to ease, and then so you may see fall off in the stock market and then a rally because of when the Fed starts to unwind a bit. So it's hard to sort of forecast this, isn't it, and see what's going on. All I would say is, going forward, like you said there, raising money is essential for small macro cap companies. So if you're researching companies, it's paramount. At the time that they have lots of cash. I mean, if they're loss making, they have lots of cash because
or they've got such a really strong business model, they're going to be able to get it. It's one of the two anyway. But I mean, you can get into this doom loop, and I think you've got the broader shoulders, and you've taken the more sort of like correct view. Yes, the data may be not looking great, but actually, when push comes to shove, what are the central bankers going to do? And it does get political. And the other sort of like thing that I've been having a lot of sort of like Twitter sort of ping pong with a guy called Cockney Rebel, who I think is Richard Crowe. He was a really good guy. He's basically a bull, and I've been that sort of reluctant bear sort of guy. And he's been battering me to a certain extent. But one thing which really does sort of underscore his sort of more optimistic view is actually PE ratios in the UK. I mean, I looked at it. It came from JP Morgan. It's 10 times forward earnings. So you're not exactly paying a rich price. Admittedly, most of them are sort of oil and banks and all this sort of stuff. But there is definitely lots of value. And I mean, one company that I've just sort of had a good look at, just on a desktop review, and I wrote an article earlier in the week, is Supreme, which is basically an FMCG sort of like 100 million market cap business that has got its own brands, one in vaping and one in sports nutrition. It licensed some in as well in terms of batteries and lighting, and then also it distributes some other FMCG businesses. But about 70% is either of its revenue is about its own brands or those licensed in. And it's trading at a ridiculously low level. I mean, it's about 9 times this year's earnings, etc. And it's got a cash flow yield of about 9%, 10% for this current year. So it generates a lot of cash. It makes 10% EBITDA margin. It's growing its top line double digits. And so when you look at it through that lens, you say, well, why is the share price so low? Well, frankly, because the market has just decimated small cap stocks. Yes, it had a couple of sort of like blips earlier in the year in terms of its lighting division and its sports nutrition. I think the price of whey protein went up in its sports nutrition and therefore took up some of the margin in that area. And then likewise, it had some overstocking with some of its supply. I mean, basically, it supplies all the major sort of like, discount retailers, because it works at the sort of the more budget end of the market for vaping and for for batteries and for lighting and stuff like that. So that's why it's a good play. If we do go through it, and we are, people trading down, people are going to move towards the more sort of like the value brands. And this one's doing well. I mean, double digits going to be growth next year, and gross margins in its biggest division. I mean, it makes 50% of its revenue in vaping. It's the 88 vaping brand. And it makes sort of like that's about half its revenues, but it's the biggest generator in terms of gross profits, and it's about 38% at the half year, and probably going to go up to about sort of 40%. So it generates sort of like much more of the value of the business. And I did a sum of the parts, and I think the shares are currently trading at about 95p. But frankly, I mean, I did a detailed desktop sum of the parts, and I was getting at £1.69. Most of that was going to be in their own brands, obviously in the sort of like the sports nutrition and the vaping. And just logically, if you've got an own brand FMCG, it's got barriers to entry. It's got sort of brand loyalty. It's got sort of like resilience because it's got a decent pricing power. And it's got decent margins, say 10%, EBIT margin, or 10% plus EBIT margins. And the other good thing about it is that, and I want to speak to the actual management team, because I think they've got a trading update at the end of April, I think it is, because that's their year end. But they've demonstrate that they're really, into the cost cutting and making sure that it's a really tight ship in terms of that cash and the cost side of it. And they're moving into a bigger distribution outlets out in Trafford Park in Manchester, and that will sort of reduce some of their cost base and their logistics costs. So, yeah, I mean, there's quite a few of them, but this is, in my view, as a summary, I mean, this is sort of like a super durable growth stock that has got real defendable sort of like economic moat there, because it should do very well in a sort of like a tougher time, and I think it will next year. And just to give you an indicator, I mean, mine's to say, well, 169 is my valuation, but I know that the brokers have got between 170 and 180, both of them. So, there's plenty, it seemed to be plenty of upside compared to a share price at 95p.
Yeah, yeah. Well, do you know what? At the moment, there's a lot of companies around that have growth and are of decent value. Now you have to go back 18 months, and you wouldn't see the value side of that at all. So, and I think that's the way forward. You've got to be very strict now on valuations, because if the market takes another downturn, will this company be hit? And you think, well, no, they're hardly valued at anything, so they can't be. So
and they've got a rock solid balance sheet as well. I mean, their net debt to EBITDA is about, I mean, I worked it out, it's about 0.4, and it'll probably be zero by the end of this current calendar year, which starts on the 1st of April for them. And they did actually just sell one of their sort of like smaller vaping brands to the French guy. It's just a French outfit, and they paid them about 4.5 million, I think, euros for it. So they've got valuable brands. I mean, typically an FMCG brand, which you own and is growing, is easy 15 times PE. Easy. Anybody's money. I mean, Unilever and Colgate and all these kind of guys have been on about 18, 19, 20 times. So one which is growing faster than the market and making good margins with a good recognizable name and with international sort of opportunities. And it's a no-brainer. Well, it seems very, very sort of well priced, and particularly when the whole company is generating 10%, cash flow yield. So it isn't exactly, I wasn't generating a lot of cash. It is.
Yeah. But do you know what would be interesting to see if it is a dislocation between the US and UK markets? Traditionally, it doesn't tend to happen. We tend to, incentive-wise, go down. But like you say, the valuations are very different, now. And does that play into anything? Because I'm seeing a lot of companies come from oversold. We've seen a lot of technical bounces from companies that are completely undervalued, and they've rallied strongly from being massively oversold. And in fact, Saietta is one of those. They had cash there.
They came out with some good news, didn't they? Basically.
Yeah. And well, exactly. Well, I picked up some Saietta. So I just
well done.
Yeah, well,
you motored into that stock.
Yeah. And I thought it was literally almost a sub 20 million market cap. They had nearly half that in cash.
Yes,
a runway for up to next year, and some big contracts landing. A very hot space. And I thought, they just seem like they're oversold and with a good potential. So I took some, and it did bounce. And same with Verici as well. I just thought they were like 10 million with $9 million of cash. I thought they got a runway to 2024. Done. I know, and I thought that's nuts. And at the stage you get these companies become so, and I think it's worth having some cash on the sidelines. So looking at companies that a good long-term prospects here. They've got cash, but they're massively oversold, and the markets are growing. And so I've seen a few of those around, and I just think it gets a silly valuation. I mean, Verici at one point was like 11 million market cap or 10 million. They're like $9 million in cash.
Well, you must have done pretty well out of both of those, because Verici's now more than doubled, and I think Saietta's probably about 2.5 times.
I think Saietta, it was up 98% at one point. I was up on them, and Verici's up. So
Saietta, when whilst you've been away, actually, Saietta came out with some good news this week. I mean, they just won another contract, which was out of the blue, actually, because I didn't realize they were speaking, but it was with a electric urban delivery vehicle manufacturer out in the States, Aron, I think it is, or Iron, for 3,000 e-drive units, which will be delivered they'll be manufactured in Sunderland and then delivered out over the next sort of like 18 months, starting, I think, September, October time. It's a £5 million plus contract, but that's just the initial one. So with a bit of luck, if you get onto a platform like that, and the OEM is successful selling these sort of like urban delivery electric vehicles into the States, then that will just carry on. So and again, it's another fabulous endorsement by a first-class sort of electric vehicle manufacturer. The technology is excellent, and they can manufacture it, and they can, deliver it. Because obviously, you might have brilliant technology, but if you have the logistics and the actual supply chain to not actually be able to do it on time, within cost, to meet the shipments for the customer just in time, then you're going to fall down, because it really is, the automotive industry expects high standards. And so, Saietta can do that. And they've got the credibility, because the management team, etc., is just full of, automotive guys who have been there for years and done it throughout, with Jaguar and from Ford and Cosworth and all these kind of guys. So, no, I think that as you say, it's a baby in the bathwater kind of stock. It's been pretty much rocky with lots of others. But that's another, as I say, it's another great contract that they've got on top of the one, obviously, in India they have through their joint venture. They've got lots of opportunities there, in fact, and we're out in Asia. And then they've got the Comet one, which is in North America as well for the big heavy duty sort of like, truck and trailers. So yeah, plenty to go for. I mean, who knows? But you have basically their house broker. I think Canaccord have got a £1.20 on it. So plenty of upside. It was over £2 not long ago, and it's just the way the market changes, doesn't it?
Yeah, like I say, the bear market can present excellent opportunities. I mean, I just think don't go too crazy in stocks, but if you're holding for a long time, and I just think that it's a growing market. Excuse the pun, but gaining traction there, and
it's electrifying performance.
Yeah,
not all
exactly.
stocks are going to do your 90%.
It's going to be sort of volatile a little bit because it's risen. If you look at the chart, it's amazing. You've gone from massively oversold on the RSI to now a bit overbought. So it's going to consolidate a little bit, but it shouldn't. I don't think it'll revisit those lows again. So it's just having a bit of patience, I think it's lots. I mean, how much cash do you have now? I mean, are you having a lot of cash? Or
no, well, I put in some. I topped up my stake, or got a full position in Pfizer, as I mentioned about 6 weeks ago. And I bought a full position in Roche as well. So that's about 10% of the portfolio. I've got another sort of 10, 15% in other healthcare, which is Pharma, which is in the process of being taken out. And then I've actually still got about 30% in cash. So I've still got plenty that I need to deploy. I'll be doing that over the next few months. The problem I have is that, because I put quite a bit of money into each one, it's quite difficult to actually get that liquidity. Anything less than 100 million market cap is really a bit of a struggle, actually. In fact, 250 million is, not that I've got any of that kind of money, but you only need a small amount in this market liquidity, and you then sort of like you just struggle to get the money into the company.
Yeah, no, do you know what? It's one of the things I did. I mean, after having a lot of micro caps, and realizing in a bear market, the liquidity really dries up, and you find it hard to exit if you want to. One of the things I've done for my spreadsheet literally is add average daily volumes on the spreadsheet, and even break it down and say, listen, and even say if you are looking even to get look at the average daily volume, and if you're looking to sell it even a tenth of that in one go, you may struggle in a down market. So I always look at the average daily volumes now in smaller cap stocks and thinking, okay, this is how much I can put in. Really, is it worth it? Or it rather go to a bigger stock that has more liquidity. But I tell
how much cash are you holding at the moment then?
35%.
Oh, we've got about the same then. So you've still got plenty to deploy as well.
Yeah. Well, I think it'll be a rocky ride. I did say a while back, I think the S&P will go up and down. I don't know if it'll fall off a cliff, but I don't think it'll rise above, much above 4,100. And I think, and the rest of the market could be like, it's a market of stocks, isn't it? There's always opportunities out there. And when you hit the bottom of the trading range, like I said, you get the bears saying we're going to new lows, and then it'll probably rally back up to highs. You get the bulls saying new highs, and I don't think any of them are right for a while. I think it'll just go between that trading range for a long time until we see a definite trend in inflation come down. And but I don't know. Talking about your videos and why people should watch them, a while back, it must have been maybe a year back, I think, or you were interviewing Gervais Williams, and he talked about Kooth. And since then, I had them on my watch list for a while. It's a digital mental health app with also people behind the app as well you can talk to. But I've watched them for a while, and when I did, they were sort of relatively sort of high evaluation when he mentioned them. And I thought, I see it's a nice area in a very hot area, but I can't sort of justify that valuation. But it's come down with the bear market, completely come down. And so they did a sort of deal in Pennsylvania, digital health, and it was a pilot for sort of 3 million, I think it was. And I think they're the biggest. I think they're the biggest provider in the UK as well.
They're very well respected in the UK. My wife works at a local school, and they use them for basically the mental health support. And they're a class act. I'm with you.
the largest single access provider for mental health support and ratings. And we know it's a growing area. I even know from my kid in school, they have actually dedicated now staff for mental health and well-being, all that stuff for children who are, are not performing in certain ways. So I thought it's a growing area massively. And they announced that contract they haven't announced the detail on the contract yet, but in California. And you realize the size of California, you think, so California, if you look at it, geographically, is bigger than Britain,
Yeah.
I mean, population-wise, it's more than half the population of Britain, so it's like 40 million population. And you can imagine in California, they're very forefront of this kind of mental health and well-being. So I'm looking forward to seeing this. But I did get in on the day that news. I'm up a little bit on it. But
well done. So you've actually bought a position, have you?
Yeah, I mean, it's again not much liquidity in the stock, so I couldn't really buy any. But I do quite like them. I think it's risen very quick on that news, but hopefully maybe it'll come back a little bit.
I like it. Yeah, I'm with you. Yeah, I mean, just to give an indication on the size of California, if you just sort of stripped it out and looked at its economy, it's one of the world's biggest. Will be one of the world's biggest economies, just straight on its own, if not in the sort of top 7, top 8. So it's absolutely enormous. And you're right. I mean, it's basically shifting their mental health sort of like telemedicine platform out into the States. I mean, it's tried and tested in the UK. So effectively operational gearing should be enormous, and the drop throughs likewise. And then once you've actually got one toehold or beachhead into such a big market, I mean, if it works in California and Pennsylvania, they'll start recommending it elsewhere, won't they? And it's a matter of then sort of rolling out. Admittedly, it is competitive. It isn't as though it's totally sort of like, game to them and it's open. But once you've actually got that sort of like level of trust, schools and higher education outlets won't just give this to somebody who hasn't done it before. You've got to have that kite mark. You've got to have that, basically the endorsements and the blue chip customers. So I think you're in a good position there.
Yeah. I mean, and what I like as well, I mean, as yet they're not making a profit, but I think they lost, what is it, $500,000. They got let me just say it. So they got plenty of cash. They got like 8 million or 8.5 million of cash, no debt whatsoever. They go top line by 21%. And they're not, losing a lot. It's like $500,000 or something. So a year.
Oh, the growth will be massive on that.
Yeah,
the growth. Once you'll find it, but the operational gearing will be brilliant because for every dollar they stick onto the top line, I bet you they operationally wise they'll get 40 cents out of that every single dollar easy, and that will just flow straight to the bottom line because they haven't got any overhead for it, well, not all little anyway.
Yeah. So there's a 3 little in microcap size sort of taking a position recently.
I mean,
not going massive on any of them really. I mean, in fact, I did average up on Saietta and I've done quite well still. But I think there'll be a little bit of sideways play unless they announce some more contracts. But in fact, that interview with Tony Gott, he was pretty much very confident of more contracts coming from India. So maybe towards the back end of the year, who knows? But
it wouldn't surprise me. I mean, let's be clear about it. If somebody bought sort of like Verici or Saietta, because they've got great technology and they've got lots of IPR and they're well set up. And you could see somebody like Dana or GKN buying Saietta because they'd get the eDrive straight away and the customer, and they'd have some customers and they've got even a bigger footprint themselves, and it would solve their eDrive problem. And then Verici, I mean, there's so many diagnostics businesses out in the States, it would just be a beautiful bolt-on for them. So strategically an M&A, who knows? But they're so badly, it's so mispriced in a lot of stocks. We've seen it through Supreme, and we've talked about Saietta and Verici. Wouldn't be surprised you could get 100% premium straight away because it still is a bargain for the other people. I mean, another one which is in that healthcare sector, is OTC healthcare products, is Venture Life, and they came out with prelims this week. And again, I mean, yes, the shares went up, etc. And I think they're trading now 43p, and they were about 38, I think. But they're in a really good position because the top line is growing at double digits. They've got operating leverage because they're getting a better mix effect of their own products, because that's growing. That's basically expanding in terms of the acquisitions they've been doing. So they'll be getting high gross margins, and they've still got plenty of spare capacity in their manufacturing. So when they get that growth and bring in more sort of business and stuff like that, that will again drop down to the bottom line. And all the numbers are good in terms of top line and margins and all this sort of stuff. But the number one which just stands out, and if you are a fundamentals numbers guy, and unfortunately I do fall into that camp, just look at the cash flow yield on it. and it's for this year, it's roughly at about 14% cash flow yield. That is hard pence, pounds, and tenors going to the bottom line. This is not funny money. This is 14% cash. I mean, that's ridiculous. That's absolutely just a gold mine. So
it's funny. It's funny. I've seen more people paying attention in the bear market. You've seen more people now learning about free cash flow and saying, okay, well, that's the real thing we should be looking at now in this bear market, because that's real cash coming to the bottom line. I know that the assets increase. So if you want to be, like I said, belt and braces, look at like I said, the cash generation margins on that, and so that's what I wanted. The company generating lots of cash. That's the way forward for a while, I think, isn't it?
Yeah, and the broker, I mean, it's house brokers, was it Singers, increased their target price from 72p to 84 on the back of it, and you can see one, and that's basically 43p today. I mean, that's almost double your money from current levels, and I think they'll get there basically. And it was funny because I posted something on Twitter about the results because I was pretty much flabbergasted how good they were, and I got a bit of abuse by a guy talking about sort of like we'll never get it'll take more than a year to get there. And I was thinking, look, I don't care. What if it takes 3 years? That's still a return of nearly 30% per annum. And I was thinking, don't miss the big picture here, because if the direction of travel is up and the value is there, and importantly, because they bought a company just before Christmas, HL Healthcare for about £13 million, and so their net debt is at about 1.4. It was at 1.4 EBITDA. It's come down in the first 2 or 3 months to 1.3. So you can see that's because of the cash generation, and it'll hit sort of like 1 or less than 1 by the end of the year. So they're generating a lot of cash. You look at it and you just say, well, okay, give it 2 years and they'll have no debt. They'll be growing at double digits. They'll be making margins of, and when I interviewed the CEO, Jerry Randall, they could well be making EBITDA margins of 25%, stick a bit of flipping, depreciation, which is not much on a factory, you're getting 20% sort of like, EBIT margins or adjusted EBIT margins, which is what they should be getting, because that's what OTC healthcare companies generate. And if they do that, I mean, it's a totally different ball. It goes over £1, no problem at all, just on the pure fundamentals, give the cash and the value. I mean, even on these lower estimates, it's still trading at less than 6 times EBITDA, and that is cash profits.
Mm-hmm. Yeah. Well, it's funny, isn't it? People, obviously, you say to people, listen, if you can see this, that if you're doing your research in the company and they have visibility towards those kind of figures, but it is in the share price now, what are you waiting for? Because right now, if you want to get, it's the same kind of thing with the house builders. Eventually they'll get back to preeminent performance. Good performing businesses. Because there's a lot of worry in the markets. Yes, but that's what gives you the discount. You're not going to get a discount in a bull market. So if you're happy to hang on and let your fundamentals improve, and a bit of volatility will happen, yes, but you don't overexpose. You're fine, and that's why if things like I said, some of the companies I'm in now that pay dividends. It's nice to have some dividends paid to you while you're waiting. Doesn't bother me. I know they'll get back to being good companies, but it's just sitting there for a while.
Well, you got that strategy perfectly right, didn't you? During the pandemic, when it first kicked off, at sort of March, April time, you convinced me to a certain extent to be a bit more optimistic, and then I sort of like came in after you, because sometimes you do have to look through the short-term turbulence, invest while there's blood on the streets when everybody's panicking, and if you do that and choose correctly, then you do make out very well. I didn't do as well as you, but it's taking that. It's going where nobody else was prepared to go on the right reasons on a selective basis, isn't it?
Yeah. I can see, one of the, we talked about Moneysupermarket, and I can't see it is hitting sort of a 52-week high recently. But I'm tempted to go a bit bigger on that, because I'm thinking, why isn't it rallying harder? Because let's be honest, we all see energy markets coming back into being offered on their deals coming out. The rest of the business is doing great. They pay a nice dividend. And I think it's okay, even though it's 50 weeks out, it's still way below where it was a few years back. And I'm thinking, it's a good business, it's a really good business.
And it could get taken out. I think, when I looked at it, maybe a bit slightly lower now, but that's a 10% cash flow yield as well. The amount of money that spins out, it's just like a money machine for a big cap company. I mean, it's over £1 billion, isn't it? The market cap.
1.3, I think.
I'm with you. you know, and you need that kind of solidity in your portfolio as well, because it helps you sleep at night when you've got sort of volatility elsewhere. So I'm with you. I mean, another one, which is, I mean, it's my biggest position, and they came out with results prelims about 2 weeks ago or 10 days, is Equals. And this is this sort of like, you know, e-payments, international sort of straight through processing platform run by Ian Strafford-Taylor and Richard Cooper. And, you know, I've interviewed them many a time, and I was just flabbergasted how good the results were. Absolutely brilliant. Not only sort of last year's, but even more impressively this year, because given the turbulence, they did like-for-like revenue growth in the first quarter, or quarter to date, of over 50%. I mean, that is just tremendous, driven by revenue per working day just going through the moon. And they've got their solutions business is just like, you know, I mean, it was the whole platform. This is the big picture. The whole platform was designed as, you know, sort of like leading bank grade technology stack to do straight through processing for small, medium businesses. Because it's so flipping good, large corporates are using it hand over fist. And they're saying to Equals, we want to use it more, particularly for our overseas businesses. And what they've done, you know, they've been working behind the scenes, you know, pretty furiously on their M&A strategy. And they've just bought a business out in Belgium, Unex. And it's subject to obviously being cleared by the regulators there. But with a bit of luck, it'll happen in sometime in Q2. This could just absolutely transform the business in 2024, because they've got large corporates in the UK who want to use the service and are demanding to use the service in Europe. Europe is what, 4 or 5 times, maybe 6 times bigger than the UK market. They're going to follow their existing customers in there, and they're going to hire hopefully a crack sales team. I mean, this technology stack that they have, I mean, they're making, you know, they're doing a run rate that by the end of this year, it could well be up to, you know, by the exit run rate, of quarterly run rate of sort of 25 million pounds sterling by the end of 2020. That's 100 million just in the UK. Just think what they could do in Germany, France, Belgium, you know, Italy, Spain, all this sort of stuff. So, you know, you can get too positive about it, and after occasionally have a cold bath and douse myself. But my fair value is over £1.60. You've got Canaccord at 164, and you know, I just think it's on a great track record. They're doing really, really, really well. They're doing not only are they hitting it organically, but they're really absolutely, you know, knocking the ball out of the park when it comes to sort of like the M&A side. And that beachhead into Europe, assuming it's going to get sort of approved, which I think it probably will, then you know, next year 2024 could be a real. I mean, I actually think it's an inflection point already. But I think 2024, if they can get that Belgian business working, would just be incredible.
It's bounced back now. It's closed at 79 pence on the 21st of March. Really a big dip, didn't it? In fact, we talked about the chart last time, saying, but now the good news is it's bounced back up, and the share price is on the 200-day moving average. It went way below that, but it's now bounced back up, so it's back in recovery mode. In fact, you know what? Next time I think we talk, the results out from Argentex will be out on the 12th.
Oh, they will. Yeah, we both own them, don't we?
Yeah. So that's a bit of that can be a bit volatile. It goes up and down. And what's going on with Argentex? Then it's nuts, really. I suppose liquidity. That's all it is, isn't it? Really.
I haven't seen any small medium cap company which hasn't been volatile over the last 12 months. It just is. It's sort of crazy, isn't it? Every single one, everyone in my portfolio, even if they're coming out with blockbuster numbers, Equals, Argentex have been knocking the ball out of the park. Every single one goes up and then comes down as people use it as an ATM, don't they? Essentially what's happening. And all it is the business's intrinsic value is going up, but the shares aren't sometimes going up as fast. And that means it's actually better value, because on a multiple basis, it's much cheaper. But I'm with you. I mean, you know, we'll wait and see what Harry Adams, the CEO, has to say. But I think Argentex will have done really well, particularly out of the sort of like, you know, maybe the volatility which has been happening. But you know, I mean, they're moving into, well, they've got obviously that beachhead in Europe, and they've got the one out in Australia, and they're putting on the tech platform as well, making real good strategic progress. So I think they'll come up some good news for me and you with a bit of luck.
Yeah, cool. Anything else happening?
Yeah, well, I mean, we had massive news yesterday for Avacta. They basically, I mean, they were. I mean, just one of their lead drug candidates, chemotherapy warhead, AVA 6000, etc. They got approval by the UK regulators to do this phase 1A study up to a cohort of 4 because they thought that was the maximum. Well, it's actually happened. It seems as though the drug is working certainly on a safety and a tolerability much better than anyone expected. And they had to go and seek approval to do a cohort 5, which they've got. And the news yesterday was that they've just started dosing the first patient in cohort 5 with essentially 250 milligram of doxorubicin in this AVA 6000 sort of pro-drug format. And what that means, it's roughly around about 2 to 3 times stronger potency-wise than standard doxorubicin. They've had, no problems, obviously, with safety and tolerability, and they've already demonstrated through the biopsies they've done that the doxorubicin chemo warhead is actually being, ingested within the tumor. Now, they're not testing at this stage in the phase 1 the efficacy. Deliberately, they're not doing efficacy because they want to get to the maximum tolerated dose. So that's the key objective of 1A. And then when they go into then 1B, they'll then start working through what the optimum dose is going to be for patients. Because this is doxorubicin is basically a well-known, tried and trusted chemotherapy, which stops the sort of replication and growth of tumors, hard tumors in people. And the best, most effective way is to basically do, it seems to be you're doing the number of cycles at the right level of sort of potency, and they'll come out, and that's the idea. That's going to be the objective of 1B, and then to refine it and to get a view in the phase 2 trials. But overall, yeah, I mean, absolutely fabulous results, because what it means is that the actual drug itself is working. We know that as designed. And once they've actually got that maximum tolerated dose, we'll move then into the phase 1 to get that optimum dosing level. But this could be a total game changer, because at the moment doxorubicin or that sort of that area, that market size is about just over $1 billion. But that's because it's limited, because doxorubicin you can only use for about 6 cycles per patient, because it's so toxic without this pro-drug format, without like the AVA 6000. Once you put it with AVA 6000, the hope is that actually you're going to be able to extend the use of doxorubicin for patients. They have a much better quality of life. They're not feeling terrible all the time, tired and lethargic and stuff like that. And the market, who knows how big the market could get to, but if you've been if it's $1 billion and you've been restricted to 6 cycles per patient, and you could carry on doing cycles with the AVA 6000, it could get to significantly higher. But anyway, that was brilliant. And
it's well followed, isn't it?
Yeah.
Whenever it's an RNS, it's always the most read on Vox. And,
yeah.
It's a lot of a faithful crowd there. And I just looking at I just got an alert on Saietta. It's now up its highest close, actually. Well, it's not closed today, but it's 59 pence now. So that's even higher. It went up to.
You've been buying again. What have we been talking? You've been buying, haven't you?
No, it went up to 69 pence intraday a few days back, but it didn't close. It closed at like 57 pence, but now it's at 59 pence. So there's momentum back in there. Yeah, yesterday that dropped. You know what's annoying? When you get on a flight, and I looked at my shares, most of them were okay. Half of them were up, some was going nowhere. A couple were down. And I got off a flight, they'd flipped. Most of them were down. And I thought, what's going on?
Yeah.
And like Saietta was down 11%. I thought, I know it's going to be a little bit volatile because it's bounced a lot from oversold position, but it's recovered the next day. It's now up 17% today. So it's liking that. So in fact, one other thing I should say, I've mentioned them before, but I have taken a little position in talking about pharma companies, Destiny's Pharma, because I just think because they've got 2 late-stage assets in sort of infection prevention. They're both going into sort of phase 3. In fact, one is funded. That's the M3 of theirs. They did a sort of deal. Could be worth up to 570 million plus royalties. So that's partnered now, so they have no financial obligation for phase 3. And their second asset, which is XF73, that's basically it's a bigger market opportunity for them. It's about $1 billion peak sales, which is double the M3 they've done a deal on. Plus, they own it outright, which they don't think with the other asset. And just looking at when I first read this, I thought, this is what? I looked at 3 brokers who've got targets on this, okay? And equity development 267, FinCap 285, short capital 290, share price at 28 pence. I thought, what? And I thought that is, but it's just the potential of the drugs, and they've got cash as well, because part of the deal they did with Sabella Pharma, so they had to raise cash. So they've got about 9 million in cash, which will see them through for over a year. But they're hoping to get a deal done on the second asset within this year, and I think they will. But it's a 28 million market cap. It's like it's nuts at the moment. Like I said, I've seen companies not even in phase one on one asset, a lot higher market cap than this. They've got two assets going into phase three, and one's done a deal on one. And I just think it's one of those. I haven't gone nuts on it. I just think when the market recovers a little bit and money starts coming back in, companies like this could really rally because they're almost there on two late stage assets in big sort of markets. So,
oh yeah, I mean, more than I do in sort of Destiny Pharma, being a sort of like biotech company, that looks like medically or clinically insane, doesn't it? That valuation.
Well, I keep looking at it again. Well, they've got cash. What's the problem? It's commercially the markets are quite big.
It's just bonkers, isn't it?
I know,
absolutely bonkers.
It's just I think people baby and bathwater stuff. Everyone's just throwing and it didn't help. They did it. People were expecting that first deal to come out, and I think buying. But they didn't realize that they do a fundraise as well. So they did a fundraise with a little bit of discount. And I think that hit sentiment massively. But now that worry about any money is removed. And so let the story play out this year should see another deal come in for them. And I think, like I said, it'll be bigger than the first deal. So that could be very significant. But
I mean, another one in that healthcare space, again, sort of like, clinically insane valuation in terms of it just being sold off is Belluscura. They came out with a good trading update. Yes, they're all on track in terms of what they're doing. So they're looking for I think it's about 12,000 units for this year, and they did about just less than 2,000 last year. So there's lots of growth, but they're on track to do that. Their Chinese manufacturers now started producing these, the portable oxygen concentrators as well, and that will service an enormous sort of like, Asian market. Plus their new model, which is going to be launched, I think, in Q2, got the sort of like an award at a really big sort of medical conference out in the States as well. So, they've just raised a bit of money in terms of convertible debt. They've got the cash runway. The products are doing well. And again, I mean, the shares have recovered, but there's still a long, long, long way from where they should be. There's no doubt about it. And anyway, we'll wait and see. They've got their prelims coming out probably sometime in Q2. But they're operationally wise, they're doing really well. I would hope that given all the distributors they've actually got out in the States, that should sell in well, because there still is a massive market for COPD, treatment, and for best in class sort of like, portable oxygen concentrators.
Yeah. Again, there's another company that's oversold. May see a bounce there, So,
well, yeah, that's right. I mean, the shares are 42p now. They've recovered a bit from where they were. But you've got the house broker Dowgate are on 150. I mean, it's a bit. It's not quite as extreme as Destiny Pharma, but it's right up there. So just shows the sentiment.
I just think things like this. I think don't go crazy on too many, but I mean, like a handful. I say 5 of these sort of really big, high potential stocks, and don't overexpose, and just do a bit of research on them. They've got cash. That's one of the biggest risks for small cap companies like this. With and then just sit and wait. And sometimes and if one starts to really move, put a bit more into it, and because now look at Saietta. Once the momentum gets, is that 24%? Is the movement in these? It just goes nuts, doesn't it? When you see, something gets oversold.
Well, to be honest, actually, they've had some big volume going through. A couple of millions I've seen, going through. So I mean, let's be clear about it. It's first class, world leading technology, and if they can actually deliver, to forget the pun, if they can actually sort of like get that, maximize that, optimize that opportunity, then it's a £2, £3, £4 stock, easy, no problems at all. You've just got to be patient, no doubt about it.
Mm-hmm.
I mean, another one on the tech side, just finally, which I own, which came out with some, good year-end trading, is FD Technology, and this is this one which has been talked about, which is the artificial intelligence business. It's a picks and shovels play. KX Insight, which is the crown jewel of that, which does real-time sort of like big data analytics, and you'll use that information to feed into your AI models, and it's been adopted by Microsoft, Azure, and it's one whole series of customers. I mean, the brokers are for this currently just finished last year, and its ARR growth was 39%. Going into next year, the brokers were at 10% for it, because it's a harder environment. They're going to do 35%, they reckon, because it's just like it's been really, they've got not only the financial angle to it, but they've also got lots of other customers and clients in the sort of like manufacturing, in sort of like power distribution and all this sort of stuff, and healthcare, and that is absolutely just flying. That because I mean, you think about it, the AI guys are absolutely flying. and they need things that can actually give them the information with a huge data set at the speed they require. And that's why, you know, the big sort of hyperscale cloud providers, the likes of sort of Microsoft, just want to get into bed with them. So that one's doing great. Their older business, First Derivatives, again, has come in strong, and they expect that to continue growing 10%. And then the problem child, which is only about 4 or 5% of revenue, is their MRP business. So when they came out the trading update, the shares went up, and then surprise, surprise, they went down again. So just because sentiment's so appalling. But I'm happy to hold that one for 2, 3, 4, 5 years. I mean, that's how I think people should look at it over that longer term. Go into a position that you feel comfortable, that from what you can see at that particular time, 3 to 5 years, and you should do quite well. I mean, as you know, my number one, you know, position is in equals, and I've held that for 3 years now. I mean, I'll be happy to hold it for another 5, 10. Why not? Because it's just been run so well, and you know, they've got the opportunity set is even bigger than it was. In fact, it's cheaper than it was when I first got in because it's grown so fast. The value and the shares haven't moved as far.
Well, that's it. I mean, the thing is, sometimes the share price, so after a big, so it did very well, didn't it? Going back a while back, it rose very quickly. It needs time to sort of consolidate a little bit of indigestion maybe, and then the business keeps improving, and then all of a sudden the valuations get more compelling, and in the end, the share price will catch up again, you know, and it'll move on. But you know, you can't just keep going up and up and up, and it's, you know, it's got to have a breather sometimes. You know?
Another one, actually, we've got the results, but Argentex for the next time we speak is K-Box. They've got a year-end result, and again, that's another one which it's come down again. It's just baby in the bathwater. It generates so much flipping cash. I'd have to work the numbers, but I bet you it's high single digits, if not double digits, cash flow yield. You know, franchise business. Anyway, it's difficult. Let's see what the numbers are before I sort of like, you know, real, you know. But again, that's another high quality branded company with, you know, sort of good barriers to entry, generating lots of cash, good margins, and you know, a passionate founder who absolutely wants to drive the business. In fact, the same is with Supreme. I mean, the guy there is, you know, Sandy Chajal. I mean, he's, you know, he started it man and boy, and he's taken it from 1 million turnover to next year they reckon it's 150 million from one. Well, that's not bad going, is it?
Isn't it? I know. I say I always like to look at those you know, founder sort of companies, because they've got a real passion for it, haven't they? You know, and they've got a skin in the game, and that's the thing. Marvelous. Is that it?
I think that's everything. Yeah, we got plenty to cover, and there'll be another busy few weeks with all the results. And as I say, keep a close eye on the US earnings season Q1, because it's going to be big beer, I think, at the end. Because if the banks start rolling over, then there'll be lots of bargains around.
yeah, exactly. Marvelous stuff. Thanks for that. Paul, let's eat some eggs now. Chocolate eggs galore.
Oh, lovely.
And speak in a couple of weeks. Cheers, fella.
Cheers, bye.